Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts and Chat for July 11th of 2022. Please hear a disclaimer for important information. Well, as we get started this week, we take a look at consumer confidence and a survey from Charlie Bolello looking at 10,000 individuals across the country in this sample size. And so, basically there's 60% of this particular survey says that we're already in a recession. And you can see on the Consumer Confidence Index that has been trailing down actually for some time now in the wake of this inflation. In fact, the Consumer Sentiment Index, which is a slightly different measurement, if you will, and it has a much deeper weighting in inflation questions. That index in particular has been very, very weak, weaker than the consumer confidence, but regardless, you see confidence is waning and you see a lot of people that believe that we're already in a recession. And I think it's important to note that, consumers and individuals that would respond to this, they don't think in terms of economics. They don't think in terms of the data. They just see what they pay at the pump. They see their rents going up. They see their electric bills moving higher, the stuff that they pay for at the grocery store going up. So that's how they feel when they say that they believe, at least 60% here believe that we're in a recession. And here's an indicator, present situation and expectations index. This is from the Conference Board, overlaid with data from the National Bureau of Economic Research. And just as a reminder, those are the folks that wind up dating the recession whenever it happens. And so you can see here the overlay of these two things, a positive relationship. Expectations tends to be a little bit more muted because that's looking out over the longer term. But you can clearly see, even from 2021, dating back to when we first started to get that whiff of inflation. And remember, the Fed said at that time, oh, this is transitory, don't worry about it. Well, it turned out that that was not the case. And you can see expectations moving lower consistently. Now, the present situation is off its peak, but you can see here just in terms of its raw index number, it's not particularly cratered, but it is lower. And the latest reading was in fact a downtick, but the expectations is what we're looking at here. And that's in that amber because expectations tend to dictate purchasing patterns and comfort level on making large capital purchases and things like that. So we're going to continue to monitor this. Here's the quick look at the labor market. Again, from Charlie Bolello, nice job here. See at the peak that we lost essentially 22 million jobs. And then we quickly gained it back. Obviously, that was due to the lockdown, and we had this massive recovery. And so we've essentially picked up 21.5 million jobs from May 2020 through June of this year. And so we're not too far off the pace where we were. We know the labor market's tight. Employment cost index is higher. Labor costs probably moving higher because of a tight labor market, but it is drawing some people off the sidelines that had been unemployed, that were essentially living off their stimulus checks. And those people realize, well, the punch bowl has been taken away. And the labor market being as tight as it is, there's still a lot of unfilled open positions. In fact, multiple jobs for every unemployed person. But you can see here clearly there's been a meaningful recovery here in the labor market. Now, having said that, this is the Challenger U.S. job cut announcement data, and you can see that it is persistently low through the balance of 2021. As you can see, as we get into April, and employment costs moving higher, inflation really taking root, becoming a problem. And also, I would say, too, that this more recent transition from the fear of inflation to the fear of an economic slowdown, you tend to see this type of thing happen where you get job cut announcements moving higher. And so this is all a function of the economy kind of slowing down a little bit. And the labor market still exceptionally strong, but you can see here that we're taking a little bit of froth off the top so to speak. And I would expect to see that number trend a little bit higher. But again, look at 2020, obviously huge numbers of cuts, even in through the end of the year when we were in recovery. But again, very symptomatic of a slowing economy. Well, here's more data on the unemployment rate as well as job openings. I mentioned this earlier. You can see on the left-hand side the unemployment rate down at 3.6. You can see the trajectory down there. You can see essentially where we are relative to relative to historical points in time. And it's rare, extremely rare to have unemployment rates that are this low. And you can see that because this data series goes back to 1948, and it's extraordinary. I mean, a 3.6 rate essentially has been matched only literally a handful of times. And so again, it's very hard to believe, going back to our first slide where 60% of the survey respondents thought that we were in a recession. I would actually place positive odds that we're in a recession as it might be technically defined, but it's extremely, extremely hard to have a recession when you have labor markets that are this tight and personal incomes that are still on a real basis as high as they are. On the right-hand side, we can see job openings. I mentioned this just a second ago, and you can see that it's extraordinarily high. So, despite the fact that we've got the Challenger survey where layoffs might be ticking up a little bit, you still see the labor market strong, job openings high, opportunity is out there, and we're essentially at a deficit of workers right now. I mentioned this as well, which is our hourly earnings. And so you can see, the latest data point, 5.1% up year over year, and you can see the trajectory there. We had a little bit of a hiccup, of course, and then, but essentially we just continue to move higher. So, one thing is apparent in looking at this chart. I mean, the rate of gain is not exceptionally higher than this trend line that was established, is essentially, almost 20 years ago. So, and this one, I think in particular, is about 17 years of data, and you can see that it's generally sloping and up to the right. There's, you had a disturbance there during the shutdown where we had a little gyration in this line, but by and large, it's been moving kind of in the same direction, maybe slightly accelerated, but again, not anything that's outsized relative to the historical trend line. Here's a very busy chart. It's basically the difference between the Institute for Supply Management Manufacturing New Orders Index and the ISM Manufacturing Inventories Index. And it's not fairly intuitive, but the real key takeaway here, you can see on the right-hand side where that's really rolled over. And the last 5 times we have had this reading as low as it is, we were already in recession. So again, I sound like I'm talking out of both sides of my mouth because I just said that it's hard to think that we're in a recession when you have labor as tight as we have it, and we also have real personal income that's still as high as it is. But here, this chart tells us very consistently that when you're at this point in this gap between orders and inventories, that you tend to already be in recession. So that's why I would give a positive expectation, or probability rather. I would say that the probability that we're in some kind of a technical recession now is certainly greater than 0, but it's not. I don't think it's 50, 75%, but it is meaningful because you do have cross currents here, and this is one that has had some reasonably predictive power, at least over the last 5 of these troughs. But here's a quick look at capital spending and some research from FS Investments, which I thought was really interesting. You can see, in recessions, those bars in between on the left-hand side, this is cap spending to revenue ratio, and you can see capital spending, which I think, by and large has been picking up since the global financial crisis, and it's essentially the aftermath on both a nominal and a real basis. You can see here that is picking up a little bit, That's, I think, frankly, a good sign. You want to see capital spending pick up. Now, obviously, in a recession, you tend to see revenue decrease. And so if you're spending at the same rate and revenue decreases, then this particular data series is going to go up. But by and large, it's a positive thing. We want companies to spend. It adds investment, and that investment generates a multiplier of benefit to the economy. On the right-hand side, you see CapEx booms tend to lead productivity gains. And we know from a lot of history that when you are able to increase productivity, that tends to help dampen inflation. So we see business investment, which, we've had a couple of hiccups, and that's echoed on the left-hand side too, but we're beginning to pick up on capital spending, even though we're either close to, heading towards, or in some kind of a recession. The data is pretty clear that business investment has upticked, and if that is the case, then you tend to see, on a lagged basis here, tend to see productivity go up, which is basically another way of saying that long-term inflation expectations should be tempered if this is a meaningful part of your analysis. Here's the daily national average gasoline price index, and gas prices have been down now for over 20 days, and it's really been kind of a unique and interesting thing to watch. As high as they were not too long ago, we did have, amidst the entire commodity basket, we'll talk about that in a second, but all the commodity basket came down. Ag commodities, energy commodities, industrial metal commodities, a lot of these commodities have come down, and even though we do have energy prices, i.e. crude prices, are still somewhat sticky, they are off their peaks, and we do see gasoline prices moving lower. Here is the ISM, Institute for Supply Management Services, Purchasing Manager Index. And so this is basically two readings. You got the all-in PMI, which is in the blue, and then the orange there is the business employment index. And you can see here that those are trending down, no surprise there. And the employment side of it, again, this probably dovetails a little bit more with the Challenger survey that we saw a few slides ago, where it's just beginning to uptick. And so even though labor's tight, job openings are really, really wide open. The services sector, which represents the majority of our economy here, is slowing down a little bit. It's a tight labor market. Things are generally still good, wages still going up, but just the employment index here moving a little bit lower. I'm going to talk about the dollar here a little bit. Dollar's been very strong, and we thought we'd see some of the froth come off the dollar, but then Russia invaded Ukraine, and that changed everything. And so obviously with rates moving higher in the US, and you've got Europe that's very struggling, we'll talk about this in just a second, struggling to raise rates at a time now where the economy there is very challenged. Obviously energy resources are in some substantial question right now, especially heading into the winter heating months. But you can see here that from the April 2008 low, the dollar has picked up, quite a bit, I should say. And you've got that number right there in the green line. You see that trajectory up there, and we're at the highest point that we've been since 2002 in the dollar index. Exceptionally strong, obviously influenced by rates moving higher. The implications of a strong dollar are not particularly supportive to emerging markets, and then commodities, which are priced in dollars. You tend to like to see a lot of weakness in the dollar for your commodity baskets. But in this case, essentially, if nothing else, that we're exporting inflation to the rest of the world. In many respects, we'd rather see that than a weak dollar, which means that we'd be importing inflation. But you can see here clearly it's just as strong as it's been in a long time. Well, a lot has been made over the Chinese yuan, the euro, and the strength of the dollar as a store of value and as a share of international reserves. And big question rhetorically is something going to ever replace the dollar as the international medium of exchange? And the answer here is not anytime soon. You can see in the very top side, even though the dollar's share of international reserves is off, from its peak, maybe 15%, but it's still 60% of international reserves. And, the only thing that it doesn't even come close is the euro, and that's down around 20%. And then, so for all this talk about the Chinese yuan or the renminbi, whatever you want to call it, it has a very minuscule representation here. And again, there's some technical things that China and the yuan have gotten into by way of being part of the special drawing rights and that currency basket that's tied to that. That's kind of a technical thing, but just looking at this chart, it's very clear that nothing is going to replace the dollar anytime soon in terms of international reserves and as essentially the global currency. Well, and here is the euro. You can see here in this chart from Charlie Bolello that from 2000 peak, obviously we just saw this two charts ago, that the dollar has picked up, over 40%, essentially, and that's extremely profound here. And then you see, essentially the euro to the dollar has gone the other way. And obviously this is a symptom of just the profound weakness in the euro and the difficulty and the challenge that the ECB has in maintaining a policy rate when you have uneven growth across its entire franchise. And that is absolutely the case now. You've got Germany, which has historically been a net exporter, is actually a net importer. And that's going to be because of the energy problem that's been created by the Russian invasion of Ukraine. And you have areas of Europe which traditionally are net exporters are now seeing that go the other way. And so when you have a demand for foreign currency because you're a net importer, that tends to lower the value of your own currency. It tends to devalue your own currency because you're in demand of other currencies and willing to give up your own. And so euro has been particularly weak. The other challenge here is because of that weakness over in Europe, particularly relative to the US, which is slowing down, but not nearly to the degree that Europe is, that you have, obviously you have a supply and demand. People are going to migrate to the highest and best use of their capital. And right now that's the US dollar and it's not the euro. And with interest rates, the ECB is really struggling to raise rates now because they don't want to raise rates too high in the face of this continuing slow growth environment that's predicated on energy and other ag commodities and so on and so forth. So that's going to be a problem for some time. Expect the euro to remain weak relative to the dollar for the foreseeable future. All right, well, here's a quick look at wages and essentially savings. So that's probably a better term for this, by income cohort. And what's really interesting in this work by BCA Research is that the lowest income cohort, and this is somewhat intuitive, is basically after some period of seeing an increase in currency and checkable deposits, essentially savings, is now whittling into those savings, where these other higher income cohorts and higher wage workers are actually continuing to see that move the other way. Here's a couple of things on inflation coming up. This one is the 5-year break-even inflation rate as measured by the TIPS, or Treasury Inflation Protected Securities. You can see this data series goes back a year, and you can see ever since March that's been coming down a little bit. There's a little bit of a kind of a mixed blessing here, if you will, because we are in this transition, and I think the sentiment of this has really taken hold literally over the last I'd say 2 to 3 weeks, where we were worried so much about inflation, and now we're just flat worried about growth. And so when you're worried about growth, you tend to reduce your expectations. You tend to begin to anticipate a recession that is predicated by slower growth and and high prices, or that's stagflation. So if you believe that, then your inflation expectations will be tempered, because stagflation usually leads to a lower growth environment, so you can again achieve equilibrium. So bottom line here is that expectations are moving lower on the break-even inflation rate, every bit as much because people feel like the economy will slow down as it does with anything else. Here's another look at inflation expectations. And so this is the what I have referred to in several of these charts of the week here as the 5-year. And so this is the 5-year forward expected inflation rate 5 years from now. So just think of it essentially as like a 10-year inflation expectation. We just saw the 5-year, and that's rolled over. 10-year has rolled over as well. We're down around 2.05%, just call it around 2%, which is where the Fed wants to get. But I dare say that inflation is going to be higher for longer. We might have 5-6% well into next year. We can live through that. That's not Armageddon. That's not a catastrophe. It's a kind of a new interim normal for us. But eventually, the dynamics will get inflation down to a more equilibrium level. Not sure that it's 2%. Maybe it's a little higher than that. We just don't know at this time. But at least this is something that's interesting to watch, because it sets the bar for 10-year rates, and which in turn sets the bar for like mortgage rates and everything else that might be tied around it. Financial conditions in the Fed. Now, we know financial conditions, have, I guess in some measure been good, and then rolling over, and then we know they're getting tighter. But we see here that what this is referring to is the terminal rate. These little pink bars at the bottom kind of infer what the terminal Fed short-term interest rate will look like. And so that, now looks like about 3.35%. Now, it was as high as 4%. Never got any higher than that, but now it's eased off a little bit, even with these tightening conditions. And again, it goes back to this theory that we expect us to slow, and the Fed's going to remain aggressive against inflation, and that's going to curb demand, which will lead to slower growth. And so that's translating here into a lower terminal rate, meaning a long-term, the ultimate rate of short-term interest rates by the Fed. Here's Liz Ann Saunders with factory orders. With all these puts and takes, and we're getting some negative data, but we're getting some positive data too. That's what makes this environment just so kooky right now. Factory orders for the last data reading were up 1.6%. That was 3 times what was estimated. And the prior month was actually revised up to about 0.7%, which is actually pretty strong. If you back out transportation, they were at 1.7%, which is sequentially higher than the last month. But basically year-over-year growth remains pretty strong here. So it seems to belie this growth slowdown motif. But again, just to point out that there, amidst some of these kind of more adverse data points, there are positive green shoots out there. Now we'll talk about commodities for a second. I'd mentioned before that commodities have rolled over, and in some cases they're down like 25%. We'll see a few of these in a minute. But here's essentially the Bloomberg Commodity Spot Index, and you can see how it is just dramatically rolled over. And you can see in the basically the trend lines here down below, just that massive drop. I mean, we've seen a kind of a cataclysmic decline of over 20% in commodities in a really short period of time. Very unusual, very unusual. Well, here's corn, wheat, and soybeans. Each have dropped more than 20%. You can see that here, where they stand relative to history. Now, if you go back, again, this is just for 2022. So let's not get too carried away with, trying to analyze versus long-term trend lines, because, these prices are clearly higher than long-term trend lines. But as you can see here, they've essentially retraced all of this gain and this, commodity inflation from the beginning of the year. Now, I do think commodities are going to remain strong relative to the long-term trend line, just because we know what the headwinds are. I mean, wheat, that's well advertised, and corn. Frankly, anything that you plant in the ground that requires fertilizer, we know. Natural gas is going to be challenged. Europe is short of it because Russia invaded Ukraine. We know grain shipments out of Ukraine, wheat, and so on and so forth have been challenged. So the global market for wheat is going to be challenged. And if you don't have fertilizer, it's tough to plant corn. So there's a lot of complicating factors here that I think will keep agricultural commodities higher for longer. Here is a quick look at gold, which is in the darker bar. And then you've got the Treasury inflation protected security. You got the 10-year tips. And we just talked about how the 10-year tips, the break-even rate has gone down on the 10-year. And you can see this relationship actually is pretty strong. And so, what this tells me is that there's some risk to gold trending lower from here. Gold is, at least it's not look like Bitcoin, but it's, it has done some good things in terms of diversification. But, if you believe that this trend line is apt to continue, then you'd expect gold to move a little bit lower. Here's the Manheim Used Car Index. Again, one of these maybe positive green shoots. I mean, we saw really high used car prices, and you can see that they're down 7% in the latest data reading. They've been very volatile as of late. It's good to see that. Maybe it's symptomatic of a trend. So this is actually one of those leading indicators. When used car prices started to shoot up, that's really when inflation took root. So I may be mildly optimistic that this might represent the fact that maybe we've seen peak inflation and that some of these factors will moderate over the next few months. Here's the mortgage market. So let's talk about the mortgage rates. Now we have seen a dramatic pullback. I mean, major pullback in 30-year fixed rates. And you can see that at the far right side. We haven't seen a weekly drop like this since 2008. Now, that doesn't make homes particularly affordable. It is helpful that they come down, but it's very unusual that they come down so much. And a lot of this has to do with this volatility in the 10-year rate, obviously with inflation expectations moving lower, and this fear of slowing growth, that's tempering these interest rates, and it's causing these mortgage rates to fall rather dramatically in a short period of time. Well, a couple of indicators here on housing. So you've got the, on the left-hand side, you've got in the light color, the Mortgage Bankers Association MBA Purchase Index. And it's advanced 1 month, and we know that mortgage applications have been low because, frankly, mortgage rates have been high, even though they just came down quite a bit last week. And then you have total home sales. It's in that darker color that's overlaid that. Now, remember, purchase index here is advanced 1 month. And so, I mean, again, there's intuitively a pretty strong relationship here. And so I think that tells us that, that the housing market is going to slow. And I think primarily the rate of gain will slow, and we'll see rather, maybe flatlining, if you will, in prices. So that's one thing. On the right-hand side, you've got again, another kind of indication here. You've got mortgage rates overlaid with the National Association of Home Builders Housing Index. And so this is a sentiment index that polls the builders. And so, that's rolling over. You see mortgage rates, even though they've kind of peeled back lately, they're still a lot higher than they were, and they moved up a tremendous amount this year. that you would expect here that housing is going to be slow for a little while. And so if you believe this chart, then we're going to have kind of a decline or mitigation in the housing market for at least 2 more quarters or 6 months. Here's the housing affordability index. No surprise here, it's moving lower amidst the continued home price increase. So we see here on this long trend line here that home prices have kind of moved up from essentially 2011, 2012 in kind of a linear fashion, except until after the pandemic began, and then you saw that gain accelerated. So they're exceptionally high. So housing affordability is still very much an issue. Not too surprisingly, demand for vacation homes has fallen below pre-pandemic levels. National delinquency rate for first lien mortgages has hit a new low. Again, this is something that doesn't happen in the middle of a recession usually. And so, I mean, this tells me that the credit quality is still very good, even though we got tight labor market, wages moving higher. Obviously, affordability is going down, but people that already have mortgages have basically more income to pay these fixed mortgages. And so, delinquency rates are pretty low. I do expect these to begin to trend back up because they generally do, and these things tend to be a little cyclical. And so you can see that a little bit, but again, very low right now, which this type of a data point would be entirely inconsistent with being in a recession. Now, switching gears here, looking at stocks, we've got free cash flow margins, and you can see the trend line as you go back from 1983, which coincidentally happened to be the beginning of this long bull market in fixed income, and this long continued migration down in interest rates, which obviously has turned just recently here as we've begun raising rates in a fairly earnest way. But again, early 1980s, we had hyperinflation. Paul Volcker came in, started raising rates aggressively, but then we reached a peak, and by 1983 we started that downward trajectory in interest rates, which persisted for many decades. And not too surprisingly here, free cash flow margins moved higher. So debt service went down, and essentially leverage became much more affordable over time. But you can see here, free cash flow margins very strong today. And again, this is something that's not necessarily consistent with being in a recession. Now, do expect that to roll over, but just looking at it in the aggregate, particularly on a trend line basis, is still very strong. So companies have a ways to go before we see an immense amount of financial stress. Now, here's something that, maybe give you a little, temper your enthusiasm over the equity market a little bit. Now, in kind of the brown line there, you see the S&P 500. In the blue line, you see essentially capital availability in the market. And that is inherently cyclical, and in some respects even seasonal too. But you can see where those are rolling over now, and so it's very consistent to have, when you've got capital being pulled away, that you have an equity market that's struggling to get out of its own shadow. And so as capital and money supply get kind of choked off a little bit, we saw the first meaningful decline in the Fed's balance sheet here this past month. Frankly, June was the first month of their actual tapering. So you expect the equities, I don't see stocks being able to rocket higher from here, but they could grind and move higher. I just want to make sure that we're tempering expectations here amidst this particular data on this chart. Here's the equity analyst upgrades and downgrades. And so essentially we're seeing a lot of downgrades, not a big surprise. Slowing growth is the theme, and what have you. So, what happens typically is that you get analysts that are much less optimistic than they probably should be. Again, I'm not painting a rosy picture here because we're in a different environment that we've been in. Typically, companies come in and beat, anywhere between 65 and 75 percent of the estimates. I'm not sure that's going to happen this time. I'm not sure that maybe estimates don't need to go down a little bit lower, and that's another reason why when you think about valuations in the market being fairly decent right now, the big question is what's going to happen to earnings, and that's the E in the PE ratio. And if earnings come down, then stocks, as it turns out, aren't necessarily as inexpensive as we thought they were. So we're on the eve of the second quarter earnings season. Those reports will begin to come out literally this week. So we're going to get a good read on where earnings are going to go. But at least the analysts are catching some of the wisdom here and reducing their rates. Well, here is a chart of the S&P 500, and then at the bottom is kind of a histogram here, if you will, of 2% intraday losses. And you can see over time, this goes back to 1962, you see a cluster of those on the far right that we've seen here lately. And we've seen volatility, the likes of which we haven't really seen in years. But we have seen it. And so I think what this is telling you, again, is we're going point counterpoint on our enthusiasm level for the markets here. But you tend to see that when you have a cluster of these large movement days, and these are 2% intraday losses, not moves, but these are actually 2% losses in a day. When you see a cluster of these, you tend to be closer to the bottom. And so the thesis of this chart is that with this rollover, it is reasonable to assume, based on this data, that we're closer to finding a bottom in the market and a point of consolidation where at least we can begin to have some recovery in the equity market. Well, we know crypto's been beat up 3 ways to Sunday, and this is a chart from B of A that, at least from their own perspective, you've seen, basically a halving in the number of users that are, I guess, the number of investors that are using crypto. And so we've seen a tremendous outflow of investor interest. Obviously, we've seen things like Luna. We've seen some cratering here. And obviously, when you pull money supply and liquidity away, that tends to be what happens to some of these things that don't have a solid footing underneath them. Well, a couple of charts here. Something that we've been focusing on actually is the dividend payers. You can see very clearly in a chart that goes back to 1990, the divergence in returns, particularly 70% outperformance since 1990 of dividend payers relative to the broader market. And I think that may become more acute because the S&P 500 index has become much more technology focused and much more long duration focused. And what do I mean by that? It just means that these are companies that have much more of a growth bias to them that don't necessarily pay dividends. So you live by the sword, but you also die by it too. And a lot of those companies in this market downturn have absolutely been clocked. And so I do think that the delta, the difference or the advantage, if you will, of dividend paying stocks and that type of a theme is going to continue to outperform. Well, here is, again, more point counterpoint here. So you've got a stock and bond allocation. So, and this is a global number, and it's overlaid with the U.S. recessions here. And so the argument here is that you have a really high stock to bond ratio, meaning that the average global investor owns a hell of a lot more stock than they did, even 10, 12 years ago, and even the 10 years prior to that. And so typically when you see a peak in this data series, you're essentially, on the eve of, or, maybe even in the beginnings of a recession. So Again, that's just what the data supports. So I want to be fair to both sides of this argument, but I did think this was a really interesting data series. Well, here's the ISM Institute for Supply Management Manufacturing PMI versus the S&P 500 price return. And again, more of this relationship where manufacturing is rolling over and then you'd expect the stock market to roll along with it. Well, as we get towards the end of this, we've got a few slides. Now, this is energy consumption in the United States. I'm not going to wax political here, but I'm just going to show you that going back to the birth of our country, what's really phenomenal. And with all of this talk about green and renewable energy, and make no mistake, I mean, green energy and renewable energy has taken a foothold in the market, but still we get 79% of our energy consumption by way of fossil fuels. And as we're struggling to make these investments in infrastructure to help green energy over time, we haven't laid a good transition plan in place to do that. So now we're struggling. We've got some coal plants and natural gas plants. Well, natural gas, I just say coal for sure, and then nuclear that's going offline at a time where we have increased demand out there. And so clearly the influence of fossil fuels is not going away anytime soon. Well, and the other thing that was interesting in a lot of reading is onshoring, obviously with the threat from China and Russia. I think more so from China, just in terms of its impact on the global stage. Not too surprisingly, companies are moving more of their production online. I think it's a national security interest, certainly on the part of many companies that want to protect their own supply chains. And so we are seeing a lot of increase in onshoring: transportation equipment, chemicals, machinery, computer and electronic products, electrical equipment, plastics and rubber products. You can see all of this up here. So we've had a tremendous surge in onshoring. And down on the bottom, you can see where that onshoring is coming from. And China, far and away, is the number one, although Germany, Japan, Canada, Korea are all relatively high, but those are for different reasons. I think, when you look at the European countries, it has a lot to do with the fact that, when Europe was shut down for COVID, and it shut down hard, like, you're literally as strong as you're weak, because a lot you're as strong as your biggest weakness, I guess I should say. And, just like, test kits for COVID, were in short supply because they couldn't get the ear swabs that were largely made in Italy. And there's just stuff like that, getting companies a little bit more interesting. That's a very primal example to a very complex issue, but clearly onshoring is a big deal. Well, speaking of manufacturing, I thought this was very interesting because it shows that back in the 1940s, as you might imagine with the war, you'd have a large number of manufacturing jobs, and it peaked at 40% of the workforce back then. Think about that. Now that's dropped to basically 9% now, and it's been a very consistent drop, I should say. So when we talk about ISM Manufacturing, keep it in some context. It's still very important, but the manufacturing side of the economy is not nearly as important as it used to be. And honestly, it's not nearly as important as the services side. That's all we got this week. Hope you've enjoyed the chart pack. A lot of interesting stuff this week. Reach out if you have any questions. Look forward to seeing you again soon. Have a great week. Take care. Bye.